Hey everyone, welcome. If you're tuning in today, I'm guessing you're the kind of person who really values focused, structured learning, right? You don't want the fluff, you just want to get straight to the actual mechanics of what makes a financial offering tick. Well, today, we've got a massive 400-plus page document on our hands. I'm talking about the red herring prospectus for Sotefin Bharat Limited. Now, I know, navigating these massive filings can absolutely feel like wandering through a maze of legal jargon and endless tables, but hey, that's exactly why we're here. We're going to strip away all that noise, extract the essential data, and give you a completely BS-free, highly structured breakdown of this SME IPO using only the cold hard facts laid out in the prospectus.
So here's the million-dollar question for today's explainer. What do you actually need to know about the Sotefin Bharat SME IPO? You know, when a company decides to go public, they're legally required to disclose an absolute mountain of information to potential investors. And yeah, it is incredibly daunting to look at. But if we distill this entire document down to its core components, the company itself, the numbers, the allocation, the timeline, and of course the risks, we can actually transform a dense legal filing into a crystal clear, actionable roadmap. You ready to unpack this? Let's get into it.
Okay, let's dive into this. 48 lakh equity shares. That is the magic number anchoring this entire prospectus. This massive figure represents the total size of the fresh issue being brought to the market by Sotefin Bharat Limited. And just for context, each of these shares has a face value of 10 rupees. When you look at an IPO, understanding the sheer scale of the equity being offered is really your ground zero. It tells you exactly how much new paper is being introduced out there into the market.
To make sense of all this, we've organized today's explainer into 5 easy-to-follow buckets. 1. Meet Sotefin Bharat Limited. 2. The IPO numbers explained. 3. How shares are allocated. 4. Key IPO dates. And 5. Understanding the risks.
All right, let's start with Section 1. Meet Sotefin Bharat Limited, the entity going public.
So we essentially have two key corporate players driving this offering. First up is Sotefin Bharat Limited, the issuer itself. Digging into the corporate history in their prospectus, their roots actually go all the way back to March 2012 when they were originally incorporated over in Kolkata. Fast forward through a few name changes and structural shifts, and they've now converted into a public limited company that's ready for the SME platform. And partnering with them, you have Choice Capital Advisors. They are stepping in as the book-running lead manager. Now, in the IPO world, the book-running lead manager is basically the financial architect of the whole operation. They assess the market demand, they help figure out the issue price through the book-building process, and they essentially hold the issuer's hand through the wildly complex regulatory machinery of going public.
Moving right along to Section 2. The IPO numbers explained, or as I like to call it, slicing the pie.
Now, what's really interesting about this slide is the composition of the issue. The entire 48 lakh quota we talked about, it constitutes a 100% fresh issue. There's literally zero offer for sale or OFS, and this is a super crucial distinction to make. See, an OFS usually means existing promoters are cashing out and selling their own personal shares. But a completely fresh issue means that all the newly created shares will inject fresh capital directly back into the company's books. Out of that 48 lakh total, 240,000 shares are strictly carved out for the market maker reservation portion. So, doing the math, that leaves us with a net issue of 45,60,000 equity shares available for the public.
Which brings us to Section 3. How shares are allocated, and understanding the different investor categories.
So that net issue of 45.6 lakh shares is strictly divided by regulatory frameworks into 3 main investor classes. Up to 50% is made available for qualified institutional buyers or QIBs. Then, not less than 35% is reserved for individual investors, which is what you'd commonly think of as everyday retail investors. And finally, not less than 15% is set aside for non-institutional investors, a category that catches high net worth individuals and corporate bodies. This highly structured division is there to ensure a solid mix of heavy institutional backing while still allowing for widespread public participation.
Now, before you can even think about bidding for your slice of the pie, there is a mandatory logistical hurdle for most investors that we really need to address. So it's time for a quick jargon-busting moment.
The prospectus mandates that all potential bidders, with one exception we'll get to in a second, must utilize the ASBA process.
ASBA stands for Application Supported by Blocked Amount. Basically, instead of writing a physical check or having funds instantly deducted from your bank the second you apply, your bank simply blocks the required funds in your account. The beauty of this is you actually continue to earn interest on your money. The funds are only truly debited if and when shares are successfully allotted to you. It's just a highly efficient system designed to protect you, the investor, and totally streamline the refund process if you don't get the shares.
Okay, I just mentioned an exception. Anchor investors are entirely exempt from the ASBA process. But who exactly are they? Let's pivot back to that 50% QIB portion of our allocation, because a massive chunk of it can be carved out specifically for this group.
By definition in this prospectus, an anchor investor is a qualified institutional buyer who is making a very serious financial commitment. We're talking about a mandatory bid of at least 200 lakhs worth of shares. The company, consulting with the book-running lead manager, can actually allocate up to 60% of the total QIB portion directly to these heavy hitters on a discretionary basis. Why would they do this? Well, securing massive, locked-in bids from institutional giants before the public issue even opens builds a ton of market confidence, and it provides vital price stability to the overall IPO.
Next up is Section 4, Key IPO Dates. When exactly does all this happen?
Let's move to and see how this builds a really clear, regulatory timeline, turning a dense paragraph of dates into a simple roadmap. The action officially kicks off on Wednesday, July 15th, 2026. This is the exclusive anchor bid period, basically one working day prior to the public opening where those large institutional bids are secured. Then on Thursday, July 16th, the bid and issue officially opens up to the public, which is when your ASPA applications actually come into play. This window stays open over the weekend until Monday, July 20, 2026, when the bid and issue formally closes. So this entire market event is compressed into just a few short, highly regulated days.
Finally, we arrive at Section 5, Understanding the Risks. What exactly is the catch here?
The prospectus explicitly outlines the risk in relation to the first issue. Because this is literally the very first public issue for Sotefin Bharat Limited, there has been zero formal market for these equity shares prior to this event. The document warns you point blank that the issue price, which is determined through the book-building process, should absolutely not be taken as indicative of what the market price will be once the shares are actually listed and trading. There is no assurance given regarding an active or sustained trading market or the future price of the shares. It's a completely blank slate. Building right on top of that, the document mandates a very direct general risk statement, which I am going to quote directly for you. Investment in equity and equity-related securities involve a degree of risk, and investors should not invest any funds in this issue unless they can afford to take the risk of losing their investment. Furthermore, the prospectus makes it abundantly clear that the Securities and Exchange Board of India, SEBI, does not recommend or approve the securities in any way, nor do they guarantee the accuracy or adequacy of the red herring prospectus itself. Ultimately, the responsibility rests entirely on the investor's own due diligence.
And there you have it, folks. The core facts, dates, structures, and risks of the Sotefin Bharat Limited SME IPO neatly extracted right out of hundreds of pages of dense regulatory filings. We've walked through a 48 lakh fresh issue, strict allocations between QIBs, retail and non-institutional buyers, and the crucial stabilizing role of anchor investors, all carefully balanced against the inherent unavoidable risks of a first-time public market entry. So I'm going to leave you with this final provocative thought. How does this specific offering fit into your broader understanding of the SME market landscape? Does seeing a 100% fresh issue change your perspective on a company's growth trajectory? Keep asking these critical questions, keep seeking out the structured facts, and never stop learning. Thank you so much for joining me on this explainer, and I'll catch you on the next one.